This is Trepp Wire Week in Review for the week ending July 28th, 2023. I'm Haley Kuhn with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, the tone of the markets remained positive again, as investors shrugged off the heavily anticipated 25 basis point rate hike, and stocks continued to rally. And why not? Earnings were impressive and U.S. economic data came in above expectations. As for earnings, banks posted better than expected numbers, and deposits leveled off or expanded for many U.S. regional banks. And tech earnings for Meta and Alphabet beat expectations. And looking at data, GDP came in above estimates, consumer confidence came in hot, and pending home sales beat expectations. Manus, there's a lot to like about these numbers, but what does it all mean for CRE?
Well, it was a terrific week for anybody who is counting on or had bet on a soft landing. Everything points towards the right directions. The economic data that you referred to, certainly quite strong. We saw the Conference Board announce really upbeat consumer confidence numbers. GDP was better than expected today. Pending home sales much higher than expected. So all systems are go, as the old expression from NASA used to be. People are very comfortable putting risk on. The markets until the second half of today were up. Earnings have been largely terrific. You referred to the bank earnings being great, which Lonnie and Stephen talked about last week. The tech earnings, by and large, have been really strong. Alphabet was very good. Meta really has whittled down their expenses. Their numbers look terrific. Even the ones that saw their stocks sell off modestly, like Microsoft, it was still a pretty upbeat report. Their earnings were strong, revenue was strong. People were a little concerned about the compressed margins, but other than that, it all feels good. When things like this happen, I always get very nervous. When everybody is upbeat, that's when it's a little bit useful to be cautious. It's probably prudent to be cautious in those moments. Enthusiasm can get ahead of reality. But there's the other expression, which is don't fight the tape. And right now, all markets are firing on every cylinder. How's that for a lot of cliches, by the way? I think I had 6 cliches in the last 40 seconds. But everything looks upbeat right now, and that is great for the economy. We'll talk about what it means for CRE in a second. The one downside for this week is all these upbeat numbers did push interest rates considerably higher today, and that probably had something to do with stocks selling off over the second half of the day. The yield on the 10-year jumped 15 basis points today. It's now back over 4%. That's an area of concern, and that could certainly dampen enthusiasm very quickly if we see that 10-year yield continue to rise. But it's really hard to find anybody out there who's particularly bearish. The shorts have capitulated, and right now there's a lot of enthusiasm.
Yeah, similar sentiment to yours, Manus. I would say cautious optimism in the sense that when everyone's feeling super upbeat and optimistic, as you said, maybe there's a reason to take pause and be a little cautious. But all the data suggests that this is good. I mean, Powell made comments yesterday that they're taking recession forecast out of their models. And so I think on the whole, this is good. The 25 basis point rate hike did not come as a surprise. And there were a few notable quotes from the presser yesterday. One that I thought was interesting was that Powell said he stressed the central bank is seeking proof that inflation is durably down. And then noted that the policymakers will take a meeting-by-meeting approach towards rates, which I think leaves the door open, to basically say they're going to pause or potentially raise if they think they need to. You hit on some of the tech earnings. Let me just give a little color on those. So Meta beat both on top and bottom lines for the second quarter, and they gave really good guidance for the current period. Earnings per share were at $2.98, which was higher than the $2.91 that was expected. And revenue jumped 11% year over year to $32 billion, which was above the analyst estimates that just came in over $31 billion. So everyone was excited about where they were. Looks like they've definitely seen increases across ad targeting and Reels monetization. And as you mentioned, Manus, the cost-cutting efforts, which we've talked about on the podcast with layoffs, real estate downsizing, et cetera, seems to have definitely played positive role for them. Google or Alphabet shares surged. They were up 7%, posting strong revenue growth. So just to give you some specifics on that, revenue was reported about $75 billion, which was a 7% jump, when compared to last year's number, which beat Wall Street's estimates. They also had a net profit of just over $18 billion, which was also higher than analyst expectations. On the mixed market reaction, Microsoft, saw margins squeezed. They saw their Azure cloud revenue growth slow from 27% to 26%. But on the whole, it wasn't, completely bad news. For some of the negative stuff, Snapchat saw shares plunge 16%. And they posted a net loss of almost 400 million. Not great news for them. So a lot of activity, mostly positive. I think the markets have reacted well. Love to get into what you think this means for CRE, Manus.
Before we get to that, I have to say, it's funny. We have gone from probably 5 or 6 emails per week from people writing into us and asking us questions and commenting on what we say to, I would say it's close to 100 a week now, maybe more. In fact, we've been talking about getting Haley some additional help because she does so much of the heavy lifting responding to our client base. And it's funny because our listeners are usually quite positive about what we're saying and quite inquisitive, and that's wonderful. Among the people that take exception to what we say, I would say half of them say sometimes we're too bullish and sometimes we're too bearish. I tend to think we call them as we see them. And this week, I think, what we're going to believe, our lying eyes or what our gut was telling us. Our lying eyes told us there was great data, great earnings, and, a surging stock market. But that doesn't deviate from this gnawing feeling I have in my gut that there's part of me that just can't believe we haven't seen a real big hiccup. When you see interest rates go up 500 basis points, when you see the volatility we had during COVID, and then the volatility we saw with the stock market sell-off in late 2022, when you see property values and CRE falling, layoffs, the economy overheating, it has just shocked me that somewhere along the way, and not to mention the deficit, the US deficit and the 32 trillion we have outstanding, that's the part that gnaws at me. I can't deny that everything on the data front has been positive this week, but there's this thing in the pit of my stomach which says, how have we gone the last 3 years without somebody, a hedge fund, a private equity fund, a commodities trader, somebody blowing up? And that's the glass half full part of me today says, great numbers. The glass half empty says, God, it just doesn't add up.
I mean, I remember last year where several firms were saying 100% probability of a recession. Just hasn't happened. And you talked about all of the macro events that, could have negatively impacted the markets and the economy, and they seem to just persevere throughout all of it. I think the one thing that maybe doesn't get enough discussion is because we're coming out of such a prolonged period of basically zero interest rate environment, the residential mortgage market has been really stable throughout this. And so if you were able to afford a home over the last 5 years and you locked in a 30-year fixed rate mortgage, I mean, you're sitting really pretty, and that number is significant, like 80% or so, or like less than 4% on the mortgage. So the increase in interest rates are not negatively impacting them today. We are seeing the negative impacts on the CRE market where the mortgages are shorter in duration and they're starting to mature. But on the whole, for residential, that's become really stable relative to other disruptions in the market. And if you look at the unemployment numbers, those numbers are still really, really strong as well. So I agree with you. Like, my gut says that I'm not a bearish person, but I have to think that there's some trouble lingering. But every quarter we see better numbers, and every month we've seen like consecutive increases in the stock market. So it is what it is. Like, people like me at this point have missed out on opportunities, probably because I'm conservative. I like it. Lying eyes and kind of what your gut is. My gut aligns with what yours is as well.
You brought up something that was very astute, and I think it spills over into these corporate earnings side. You talked about rates being low for so long and people having locked in. I think historically people looked at spikes in interest rates and said, this is going to come back and bite these companies' earnings over time. And and it's going to weigh on these guys. And the reality is so many of these firms locked in rates when they could in that 2 and 3 and 3.5% range, and they locked it in for as long as they could, that what would have been a really painful situation maybe 20 years ago is turning into a very benign situation right now. And I think that that's bailing a lot of these companies out, these companies that just loaded on the debt, bought back shares, and now are just sitting pretty with 3% debt in a 6% market. Turning our attention to CRE, we don't want to get too far down the path without talking about this. I'm going to theorize on something. We've talked before about the wealth effect, that when stock markets are rising, people feel more confident, they spend more money. They go to Ruth's Chris instead of Outback. They go to Disney World instead of the local water slide park. They spend money. You know, it's tried and true. My thesis is when you have moments like this, when the data looks good and stocks are up, that it does lend itself to people being more frisky on the commercial real estate side. If you're sitting on distressed assets, you might be more likely to hold out for that Hail Mary pass and get that tenant that saves your property. If you've been chomping at the bit to buy something, you know, trying to sit on dry powder, you might get an itchy trigger finger and jump in now because you just feel a little bit more flush than you did 2 or 3 months ago.
Yeah, I think there's truth to that. When we started talking about delinquency ticking up and other things over the last year, and there was a lot of uncertainty around rates, I think people were definitely holding on tight to what they had. I think to your point now, you know, I see a lot of chatter on Twitter now where it's like wall of maturities is just kind of getting poked fun of and all this stuff because we haven't seen the distress that everyone thought we would see. And maybe that makes people a little more confident in making a play. You do make a valid point too. If you look through our data, while we report on delinquency for each of the markets in each of the property sectors, we actually have some dashboards that look at properties, percentage of properties that have debt service coverage less than 1. And in almost every instance, there's a higher percentage of properties with debt service coverage less than 1 than there is delinquency. So by definition, that means that there are a significant number of owners that are having to cover the mortgage out of their hip pocket each month, and they're willingly doing that and not letting the properties go into a delinquent status, which tells me that they're bullish on the viability of that asset or those assets, you know, in a particular market. So that might be something that we could put some research out on to kind of give some quantification of that. But to your point, man, it seems like in other downturns or in other disruptive markets, people have been a lot more willing to kind of throw the keys back and just run away. And here, because of some of the optimism with the earnings and others, we've seen people hold on, and hopefully for them, they're able to hold on long enough that the values come back.
It will be interesting to see, no doubt. I think that, you know, there's a possibility. Sentiment clearly was incredibly bearish for CRE for about a 6-month stretch between last fall and this spring. I think we're coming out of the most bearish feeling. It is possible that what we see in the next 2 years is a replay in some forms of what we saw from 2018 to 2022, which was decimation of one segment. In that period, the decimation was in the shopping mall segment, although there was an awful lot of extend and pretend during that time period. But everything else either muddled through or did very well. Multifamily and industrial did very well. Hotels, you would say, muddled through, and probably only muddled through because of COVID, right? It would have been better had we not seen COVID. We could be looking at another situation now where 2 years from now, we're looking back and say, goodness, it was a disaster for offices and people lost a lot of money in that segment, but everything else was okay. Everything else muddled through. And that might be, you know, the epilogue that we're telling in 2025 or 2026. We'll see.
Yeah, I agree with you. Like, we actually have some data here that talks about some of these lesser discussed property types. So strip malls, retail centers, however you want to call them, seems like everyone is saying how great they're performing in the market. So we've seen a couple of reports this week. Leased occupancy rates for strip center real estate on the REIT side was about 95.3%. That was according to Green Street, highest level it's been at over the last 8 years. If you look at physical occupancy, sitting over just 92%, right about where it was pre-pandemic. And then if you look at Some other indications of just overall retail strength and resiliency. There's been a lot of publications around landlords not having to subdivide larger dark big box or anchor spaces that are 10,000 plus square feet. They've been able to get those leased with other single tenants, and so there's a lot of really strong news coming out of the retail sector, which again, Manus, if we were talking about retail a couple of years ago, nobody would be saying how strong that market is. And during the pandemic, grocery anchored retail kind of carried the mail, but here it's pretty much all levels of retail are seeing a resurgence, both in leasing activity, occupancy, and the ability for landlords to push the rents.
So let's talk about another property type that we don't get to a lot. We did see a self-storage company sold this week.
So this is what I'm talking about with Frisky. This is a deal that maybe doesn't get done 3 months ago because of skittishness about interest rates and a risk-off tone to the market. But this week, what we saw was Blackstone sell a huge portfolio of self-storage to Public Storage. This particular portfolio went for $2.2 billion, which represents about $244 a square foot. This particular property set was bought by Blackstone only 3 years ago from Brookfield. When Brookfield sold this portfolio in 2020, it sold it for $150 a square foot. So a couple of thoughts coming out of this portfolio. And this portfolio also sold in 2016 for a fraction of that $150 a square foot. So what are the takeaways from this? The takeaway number one is Blackstone is selling this for $2.2 billion, which is real money by anybody's standards. That's a big price. They're paying what is basically a 60% premium per square foot to where this thing sold just 3 years ago. And it tells you that deals are getting done now and there's risk back on. And that's a positive sign for the market. And it's part of the theme we opened with, which is people are getting frisky. People want to be in the market and they want to start buying.
Yeah, and I think it's interesting to note on this one, we've had a lot of discussion around BREIT redemptions for the last several months, and that required them to liquidate some of their holdings. And this was the one, a pretty big number for them to get out of at a really nice price for them relative to what they paid when they acquired it. So, I think it shows if you're bullish on Blackstone and the BREIT, they have some quality assets. This is maybe a short-term problem that they have with the redemptions, and they can stabilize by selling off some of their, better producing properties. If you're bearish, how many of those properties do they have to exit to continue to meet the redemption limits? But it'll be interesting to see. I think we talked about Prologis and the large industrial acquisition a few weeks ago. These really large scaled type of portfolio transactions may not directly indicate what's happening in the smaller, sub-institutional markets. Because I know for self-storage broadly, there was a couple articles this week that talked about some of the rent declines that they've seen at the smaller operator level, occupancy challenges that they've had. These are probably a lot nicer properties and a lot more investment grade, obviously. But I think for that sector more broadly, there's still some potential distress that's hanging out there based on the run-up in prices over the last few years.
Yeah, this was 127 properties, 9 million square feet. And it didn't seem like it was all that long ago where self-storage properties in general, which maybe I'm talking about the lower end stuff, but this stuff was trading for $60, $70, $80 a square foot. This is really a tripling of the value from 5 years ago as to kind of, what the everyman type self-storage was selling for back in 2018. It's a remarkable rally for that part of the market.
Yeah, incredible price per square foot on this sales transaction. Probably got to be one of the highest in that asset class for sure.
So we have a lot of office news today: crabgrass, green shoots, and some mixed greens in there.
Let me start with the crabgrass. And just as a spoiler, I have to say that we have more green shoots than usual this week. We have a lot of stuff that was somewhat upbeat. It's not popping corks necessarily, but it was more good than bad. So let's get right into it. So in the crabgrass side, a trading alert that we put out this week, Schwab announced it was going to downsize its San Francisco office. They are a major employer in the Bay Area. A couple of years ago, They moved their headquarters to Texas, but they remain a very viable employer in San Francisco. They have substantial space at 211 Main Street. That is a 420,000 square foot office. Schwab is the sole tenant on a lease that runs to 2028. It does back a very big CMBS loan, and that CMBS loan is due in less than a year. So this is an asset that may be difficult to refinance, even though Schwab will be in place for another 5 years paying rent. Finding a lender that's willing to take out the existing debt might be a challenge. Another one which I found interesting in Baltimore, we talk a lot about values being cut in the CMBS market. A property that was worth $400 million in 2016 being revalued at $200 million, for example, an office or a mall or something like that. And normally our data comes from the fact that a loan has become delinquent, is with a special servicer. The special servicer had ordered a BOV, or a broker opinion of value, or a bona fide appraisal, and has come up with a new number for what the property is worth and reports that. That's often where our data is coming from. This next story was a little bit different. This comes from the Baltimore Business Journal, and they reported that 100 East Pratt Street in Baltimore had its value cut by about 50%. The owner of that property went back to the city, appealed the valuation, and the property value was cut from 187 million in 2016 to 93 million most recently. Part of the reason, or the justification for that cut, was the fact that they are going to lose T. Rowe Price as the dominant tenant in that particular property. And this will be something to keep an eye out for, that it has two impacts. Number one, as these values get cut, it does reset the market, right? If a municipality is willing to agree that values are down 50%, that is a data point that other owners will look at when they're looking to buy or sell properties. Baltimore has been particularly hard hit with quality of life issues. They've seen several properties sold in the last couple of weeks at big discounts. But these types of data points can become a self-fulfilling prophecy and can spiral lower. This is something that Lonnie has talked about in the past, the fact that one data point can really reset a market.
Yeah, I think this is an interesting discussion. Both of these cities in the first two stories here have quality of life challenges right now that are definitely impacting the office market. On the assessed value story in Baltimore, it's not just sales comps that indicate the market's being reduced and impacting values. When these things are reassessed, it definitely has a negative drag on the economy. Lower taxes for the owner, which is a positive, but also lower tax collection for the municipalities that are providing services. And so, these are things almost like sublease availability or downsizing from a tenant perspective that have potentially longer term impacts for those local areas. This is another one that could potentially have challenges for the tax collection side of this business. So hopefully Baltimore, San Francisco can get things figured out and we start to see an uptick there. But based on what we've seen over the last couple of months, I suspect we're going to see continuation of some of these trends.
Let's talk about sublease stories. We saw subleases across the country this week.
Yeah, I'll run through these very quickly. Some good, some bad. In the suburbs of Chicago, this is probably the worst one. Zurich, North America, has put 360,000 square feet of space out for sublease at its headquarters in Schaumburg, Illinois. The space represents about 46% of the firm's square footage. The property doesn't back any CMBS debt, but the additional inventory could certainly weigh on office properties on that I-90 corridor west of O'Hare, which has been hit hard over the last 10 years. We've seen a lot of companies either pull out and move south or pull out and move back to downtown Chicago. So that's a story worth watching. In Denver, home services giant Angie has reduced the size of its Denver HQ. That story comes from Denver Business Journal's Cassidy Ritter. The firm is releasing about 50,000 square feet. It still occupies 100,000 square feet at 3601 Walnut Street. In Columbus, I think we may have covered this before. Cover My Meds is making sublease space available in that area. They're making 51,000 square feet available via CBRE in the Columbus market. On a more positive note, VTS has announced it will sublease some space at 3 Bryant Park. They're taking some space that Salesforce had cut back. And then lastly, I really like this one. Seattle is a market that we've kind of picked on a little bit, rightly so, in the last 6 months. Enormous amount of space coming back to the landlords, more than 2 million square feet coming back from Microsoft, but Amazon and others giving back space. In that particular market, Moderna signed on for 50,000 square feet of sublease space from WeWork. WeWork has really been a nit on the back of landlords around the country, signed long leases 5 years ago. In some cases, they've reneged on their leases. In some cases, they've terminated and paid a fee. But the landscape is peppered with stories about WeWork holes in rent rolls that have caused distress around the country. And this is one case where Moderna has stepped in, taken 50,000 square feet, and will now keep that from being a situation for that particular property.
Yeah, it's interesting. You talked about a couple of cities that I've been in recently, man. So in Chicago, I was there last weekend. Downtown was still kind of a ghost town relative to what it was in its heyday. River beautiful, buildings still beautiful, summertime weather incredible, retail foot traffic pretty much non-existent, and a lot of for lease signs in all of the offices. I know the story you mentioned was in the suburbs, but still the city is definitely a shell of what it was on the office and retail side. But it's great news for the VTS stuff in 3 Bryant Park. I've been up in New York here for a couple of weeks, and I'll tell you, it seems like the foot traffic, at least in the middle of the week, has really picked up from where it's been the last couple of months. And it seems like there's a lot of activity around the CRE space here too. So it's great to see some of that sublease space from Salesforce getting absorbed.
And we'll pause for a moment with a message from our sponsor this week. This episode is sponsored by Better Pitch, the experts in private equity pitch deck design. Whether you need a fundraising, corporate overview and track record deck, or investor reporting collateral, they have you covered. Better Pitch has developed pitch decks for raises as small as $1 million and as large as $500 million. The best part? Better Pitch completes all design, copywriting, and market research. Better Pitch is the plug-and-play option to deliver an institutional quality deck, and they deliver the final product in a PowerPoint file for you to use on future deals. Visit betterpitch.com today to learn more. And let's talk about the positives. We do have some green shoots this week.
Yeah, like I said, it's a number of them, and I'm really happy to report them. These things seem to be happening. We've talked about Seattle, that particular market, which has been heavily hit. There's been a couple of other markets that we've talked about in terms of sublease space availability that also had some green shoots this week, and I'm happy to bring them up. Let's start in Minneapolis. Longtime listeners of the podcast will know that there's an enormous amount of sublease space in that market. We've talked about healthcare and insurance companies, along with Thomson Reuters and Target, giving back enormous amounts of space in Minneapolis, St. Paul, and the suburbs. But here's a real positive one. This comes from Caitlin Anderson of the Minneapolis St. Paul Business Journal. The RBC Gateway Tower property downtown has sold for $225 million. This is a nice comp for that part of the market. The number comes in at $430 a square foot. The sale represents one of the biggest sales this year in that part of the country. The complex itself is a combination of office space, hotel, and condominiums. The sale includes only the 525,000 square feet of office space, but the $430 per square foot is a nice number in a market that is not overwhelmingly strong right now. Next market we'll talk about is in Atlanta. Again, another market that's had a lot of sublease availability. There, AT&T has signed a 120K square foot lease at 1277 Lenox Park Boulevard in Brookhaven, Georgia, so just outside of Atlanta. Interestingly, there, AT&T had given back space at that complex a couple of years ago, and now is retaking space that they had previously relinquished. So that story comes from Biz Now. In San Francisco, another market that we thought had nothing but negative news there. Autodesk has renewed a substantial amount of square footage at One Market Plaza. Previously, Autodesk had put 75,000 square feet out for sublease. The question remained, what were they going to do with their other 100,000 square feet that were coming up for renewal? They decided to renew that space, which is a rare vote of confidence for the San Francisco market and one that was desperately needed. So AutoZone taking 100,000 square feet and renewing that lease there. That is also, by the way, a huge CMBS loan, $975 million. Google is the top tenant there with 22% of the space on a lease that ends in 2025. So between the market needing some good news and this particular property with maturing debt and other tenants with expiring leases coming up, this is a good, a positive story without exception. Turning our attention to Scottsdale. This story comes from the Philadelphia Business Journal's Ron Davis. Vanguard has confirmed that it signed on for $135K at the North Site Corporate Center in Scottsdale. This is basically a doubling of the square footage that Vanguard, the big money manager that is headquartered outside of Philadelphia in Malvern, PA, they are doubling down on their square footage in the Phoenix MSA. Real Estate Business Online, they reported that Waste Connections US has signed a lease renewal in the Woodlands, 30 miles north of Houston, for 120,000 square feet. This is at 3 Waterway within the Woodlands Town Center mixed use development. Positive story there. And then lastly, finally, I can wrap it up here. We reported this week that a low DSCR portfolio loan paid off ahead of its maturity date in July. This is the Briarcliff office portfolio backed by 5 offices in Kansas City, MO. The property's total 420,000 square feet. The loan makes up 12% of the collateral behind a 2013 deal. The deal is part of CMBX 7. DSCR was under 1.0x from 2019 to 2021. And even in 2022 was only 1.12x, yet the loan paid off ahead of maturity. And that's, I think, a half dozen really positive stories that I guess underscore our open, which is green shoots, positive news starting to, just sprout up everywhere.
And for those of you listening, Manus was so excited to read the green shoots out this week that he did all of that in a single breath. He'd been practicing all week because we haven't had some good office news in a while. So when you listen to this, just know that was just one breath. That's how pumped he was about this stuff. And I will say some of these were like green shoots with some extra fertilizer. So the story in Minneapolis at 430 a square foot, really, really great news for that market that's been downtrodden. The AT&T stuff in Atlanta, I thought is interesting in the sense that they had announced that they're requiring workers to come back to the office, and then there's a correspondence in the amount of space that they need. So they've seen the increase of the rental space there. And I think there was a Bloomberg story today where Citigroup announced, at least for their UK properties, that they're going to be monitoring employee attendance. So there's maybe a few signs of actionable data here that says this return to office movement that we're starting to see is maybe getting some legs. And then the stuff in San Francisco, really great news to hear some positive stuff about offices there. Last comment on that one. That property was valued. You said the loan was a $975 million loan, Manus. Back in 2016, when that loan was originated, the property had been valued at $1.7 billion, just to give some context into how big of a deal that is. So great news. I'm excited to hear some positive office stories. And I think it's spread pretty broadly across the geography as well.
It's funny you should bring that up, Lonnie, on the single breath. I do tend to get worked up. I have to say that I can be excitable from time to time. And we have a wonderful woman in our office. Her name is Amrit. She does business development for us, and she and I get together every 2 weeks or so to just talk about the market and what we're seeing and the color in there. And we were joking the other day at the end of our 40 minutes together that when she comes into my office, she's a clear like 120/80 blood pressure person. And when she walks out, she's like a 220/180, that she comes in calm and she walks out worked up, because I get so excitable talking about, sometimes it's good things, new products we have developed, new data we come out, new hires we've made, exciting things that Trepp is developing, new business opportunities, or sometimes it's the state of the market. But yes, you've hit the nail on the head. I can be excitable from time to time.
Let's see if you'll get excited about retail this week.
Yes, I have to turn my attention. And by the way, a big thank you to Stephen for pinch hitting for me last week. I heard he did a very nice job with that. So on to retail. So some good, some bad, some mixed. Let's start with a really good. We put out a trading alert in the last couple days. Westfield, this is Unibail Rodamco Westfield, which has been trying to sell off its mall portfolio in the US for several years. They've had some success, but they're still sitting on tons and tons of assets. They sold their Mission Valley shopping center in San Diego for $290 million, so a really hefty price. I think investors were expecting a big 2013 loan backed by this mall to extend. It now looks like this thing will prepay ahead of its maturity. The mall backed a $155 million CMBS loan. It was known as the Westfield Mission Valley asset, and it was slated to mature in October. So good news there. The entire loan backed CMBS 7 debt. So a couple of positive stories for people that were long CMBX 7. They saw some positive outcomes this week. Another story, I guess you'd call this mixed green. We got the details on an extension for the Poughkeepsie Galleria. This is a big shopping center, I'd say about an hour and a half north of New York City. Poughkeepsie used to be a big hub for IBM. July remittance data showed that the loan had been extended to early 2025. This particular asset was valued at $237 million in 2011. The value was lowered to $68 million in 2020, and DSCR was negative and has been negative. Occupancy is only 56%. The property backs about $130 million, give or take, of CMBS debt. So even though this thing is underwater by $60 or $70 million, the property owner continues to fight the good fight. I think it's Pyramid that is the owner of this particular asset, and they've emerged with an extension. Going back to Westfield, we did have indications in special servicer comments that Westfield is trying to work out a modification and loan assumption for the Westfield Palm Desert Mall. This particular asset is a 575 square foot regional mall in Palm Desert, CA. The loan is about $125 million in size and backs a 2015 CMBS loan. This is of a piece with the Poughkeepsie Mall. This particular mall was valued at $212 million in 2014 and backed that, like I said, $125 million loan. The value was cut to $55 million in 2021. And here you have a sense or a case where a new owner might be stepping in, taking over this debt and assuming this loan. And we saw that happen with Bridgewater in New Jersey. We may see it happen here. This is, and we've talked about the Poughkeepsie Mall. This is really kind of an unbelievable twist for these loans, things that have between $50 and $100 million of negative equity coming out potentially without a loss. What do you think, Lonnie?
Yeah, I think two interesting stories. First off, I just want to say, as a non-native New Yorker, I'm glad that you said Poughkeepsie, because I would have never got that correctly. And I'm thankful I don't have to try to spell that, because even with it spelled out in front of me, I'd have a hard time with it. So interesting spelling and pronunciation of that. But to the malls, it's in the Westfield Mall. You mentioned the $55 million appraisal in 21. It was increased a little bit later in the year at about $68 million. But yeah, I don't think any of us would have on our bingo cards that malls that have 50 or $60 million in negative equity, that people would be digging in and trying to keep these things working. So extensions in this space have become hard to come by. And so it's great to see that we're getting a couple of these. I'm hopeful for the operators that they have a longer term strategy in place to try to execute some sort of value add or collateral improvements on the CapEx side so that they can get that occupancy and DSCR number where it needs to be.
And I'll close out with one more, which isn't quite so positive. Those first three were all fairly upbeat. The Fair Oaks Mall, which backs about 162 million in CMBS debt, there this month, the special servicer noted that the borrower really doesn't have any appetite for a commitment of capital, and the special servicer workout code flipped to foreclosure. So that would be one where the borrower does throw in the towel. The loan missed its 2023 maturity date. The collateral is 800,000 square feet of a 1.5 million square foot shopping center in Fairfax, VA. That might be one where the trend goes more negative than positive, counter to the Westfield stories and the Poughkeepsie Mall. But I know last week, Lonnie, you guys talked about workers in federal offices not coming back to the offices. And we just talked about Baltimore offices there being cut in value. Fairfax here now, another negative story. I have to think that there's some correlation there, that so much of these economies in the areas around DC, in the DC suburbs of Maryland, Virginia, I mean, Baltimore is not really a suburb, it's its own city, but they are so dependent on those workers for their retail, for their office values and so forth, that they might be an outlier to the downside, along with San Francisco and other in other areas, because of that exposure to segments where the office workers not coming back.
Yeah, definitely. We've seen that even in some of the multifamily stuff. So occupancies and pricing power from the landlord perspective have pretty much gone out the window, with the office workers not needing to pay a premium price to be close to their office anymore. And so, there's a lot of downstream negative implications that are being felt in that market, I think, largely due to a lack of office attendance. And well, as we talked about last week, there's really no impetus from the federal government's perspective to mandate any type of worker return to office. And so for markets like that with really heavy government concentration of a tenant base, I think you're going to see some prolonged challenges across retail, multifamily, and some of these other, foot traffic heavy type of industries.
And quickly, this week we released our bank CRE loan performance report, and we found there were higher delinquency rates, higher risk concerns, and an origination slowdown in Q1.
Yeah, so you mentioned it, Haley. Delinquency rates for CRE loans were up across all major property types. The only one that was an exception was industrial, which remained flat. And we also saw pace of origination volume slow dramatically in both Q4 and Q1. Q1 commercial mortgage origination volume at about 40% of the average 2019 quarterly origination. So if you'd like to see the full report and get the insights beyond what we highlighted here on the podcast, shoot us an email at podcast@trepp.com, and we're more than happy to send that full report out to you.
So let's turn to shout outs. I know, Lonnie, you had a few, so why don't you kick it off?
Yeah, thanks, Haley. I had a couple of people reach out this week and wanted to give some shout outs too. So Alec P with CCIM and NAI loves the Treppwire podcast. He actually had me out to Chicago this last weekend to present state of the market update to the CCIM instructors that were there for their continuing ed. Bo B with CCIM, loyal listener. We gave him a shout out last week. I got to meet with him in person again in Chicago this week. Great guy. And JT with CCIM. He's from the North Carolina market. He said, we got to get the Treppwire podcast out to North Carolina and speak to his local CCIM chapter. So more to come on that. Evelyn W with Transwestern in Houston emailed in. She loves the podcast. Would love to get a Treppwire t-shirt. And then Keelan G, this is an interesting and cool one. Real estate student at Princeton. He participated and joined the Market Pulse webinar that Stephen and I did yesterday. Immediately connected with me on LinkedIn afterwards and sent me a pretty interesting message, said that he loved the information we share on the webinar. He's an intern at a PE shop out in San Francisco. And one of his projects for the summer is to tune into our podcast and webcast, take notes, and deliver them to the staff. So thought that was really great. Appreciate you listening, Keelan, and happy to help you however we can with maybe supplementing some of your notes.
You might have just given other people an idea for their interns.
We're going to see our listenership plunge, Haley. Bite your tongue.
Okay, and a few more. I'll try to run through these as fast as Madness can run through some sublease and crabgrass stories. Alexander B said, "Hey guys, a new listener here. Thinks we have a great group of personalities and characters." Stuart B said he looks forward to listening to the podcast every week. The information is invaluable and he encourages all of his senior staff to listen as well. John M said, "Thanks for publishing a fantastic podcast each week. Our friend Oz reached out to chat, so we'll get back to you on that." Louis B is a longtime listener. He said we've been the go-to source since inception. Camille A, we create the best capital markets content out there. Joffrey C said he listens to the podcast at least twice to not miss anything. Martin K said he's a 20-year veteran in the industry and a longtime listener to the show. Him and his wife listen to the show every weekend in the car. He said it's great to hear the stories that they may have missed during the week. And Manus and Lonnie, your voices actually lull their 5-year-old and 3-year-old to sleep. Very
I wish
cool.
I had that gift when my kids were under 5. I didn't have that gift then. They seemed to want to stay up till 11 o'clock at night, regardless of what I said.
Were you talking CMBS with them?
That was my mistake. I was probably talking gibberish.
You know, Manus, that baby market is pretty profitable. Maybe we could have Haley cut some outtakes here and we could sell the Lonnie and Manus put your baby
Lullaby.
to sleep. Yeah, lullaby.
Oh my God, I could picture that. Like you pull this big cord and you let it go and Lonnie's voice comes out talking about cap rates. Oh my God.
Thornton R loves the pod, listens every week while driving or exercising. Paul M is a big fan. Seth L loves the podcast, but we owe him a Trepwire t-shirt. So I think we promised him one. We'll get your address if we don't have it. Keaton H said he's a longtime listener, big time fan, and we are going to discuss some of his build to rent products. Asif really likes the podcast and says he's always getting up-to-date information. Kevin P said he just started listening and it's become his go-to. Soren O, Brock H, he said this is his first time emailing, but he's a longtime listener. He actually started listening to the podcast after we had Brian Stofers from CBRE on in June 2020.
That's remarkable. He starts emailing just yesterday and his very first email is to us. That is remarkable.
Jamie D, George M appreciates our thoroughness on the podcast. Adelina R, big fan. And Todd S said, "Lonnie, I just wanted to let you know that ever since you mentioned the story about your cab ride with the lady from the elevator industry, he thinks about it every time he gets in an elevator. So you might have scarred him."
Yeah, I know Todd S, and I know he's a pretty resilient young buck. I don't think he's too nervous. He's gonna face his fear. He's gonna get in that elevator and he's gonna keep rising to the top.
And one last shout out to our friend Dan M. He just caught me to let me know this on the night we're recording, so good timing. He is at the IMN event in Orange County at a dinner table with a bunch of people from across the industry, and they're all discussing Trepp and the podcast. So thank you to everyone there. And we have a lot more, as Madness said earlier. We had probably over 100 inbounds this week because we had offered up our multifamily syndicator report, our expense report, or an invitation to our webinar series. So thank you to everyone who reached out and requested something. I hope I got to everyone. If you didn't get an email back, please email us again and we'll make sure to get back to you this week. And if you want another shout out, you can always email us again at podcast@trepp.com. So there's been a big black hole in the retail industry and it was movie theaters, but I think that's really changed in the past few weeks. I mean, are you guys team Barbie or team Oppenheimer?
Well, I went to see Oppenheimer. I'm glad I did. I thought it was a terrific movie. The reviews were really through the roof. They were kind of Godfather-esque in their effusiveness of the movie. It was really hard to live up to just how great the reviews were, but the movie was very, very good. I really enjoyed it. I thought it was terrifically done, I think. And I don't want to give any spoilers to the movie, but I will say this, and it'll be more of a sobering last remark from me for this podcast. that the movie does bring up a lot of the big issues of the time, the Cold War, international relations between the US and Russia, World War II, the use of atomic weapons and so forth. And it just, the big thing I took away from it was not the story about Oppenheimer. It was more about, I don't know why this was so weighing on me after the movie, but there's so many big issues that remain out there today that fall into the hands of our politicians. And we're now getting into the silly election season again. It's so important to choose wisely in these forthcoming elections that we sometimes tend to forget the weighty issues of the day that face the people. And it's really important that we elect people that really keep humanity at the forefront of everything. It's not a presidential thing. It's really from the local politician all the way up to the presidency. We need humane people in those seats. And that was my takeaway from Oppenheimer. So a little bit sobering to end the podcast from my perspective.
Yeah, I don't know how I could say Team Barbie after that. So so I think Manus just wrapped it up for us, and that's where we're going to leave it.
I might be team both and go see them both in one day, but we'll see if that's possible. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the Trepp Wire podcast with your favorite provider. Thank you for listening and stay well.
All right.